In the ever-evolving landscape of American food consumption, brand loyalty isn't what it used to be. Today, we're diving into 10 American food brands that are hemorrhaging consumers at an alarming rate. While some of these companies have been household names for generations, shifting consumer preferences, health concerns, and emerging competitors have left them struggling to maintain their market dominance. Let's explore why these once mighty food titans are now watching their customer base dwindle. First up is Kraft Heinz, a company formed in 2015 through the merger of two iconic American food manufacturers. For decades, Kraft's macaroni and cheese and Heinz ketchup were staples in American pantries. However, the company has been facing significant challenges in recent years. In 2023, Kraft Heinz reported a 7.8% decline in sales volume, indicating that fewer consumers are purchasing their products. The primary reason? A growing consumer preference for fresher, less processed foods. Kraft Heinz's portfolio is heavily weighted toward packaged and processed foods, which have fallen out of favor with health-conscious consumers. Products like Kraft Singles, once a lunchbox staple, are now scrutinized for their artificial ingredients and preservatives. The company's slow adaptation to changing consumer preferences has cost them dearly. While they've attempted to introduce organic and clean label versions of their products, these efforts have been too little, too late for many consumers who have already switched to alternatives. Additionally, Kraft Heinz has been hit hard by inflation and supply chain disruptions. The company has raised prices significantly over the past 2 years, with some products seeing price increases of over 20%. These price hikes have pushed budget-conscious consumers towards store brands and more affordable alternatives. Despite being a $26 billion company, Kraft Heinz's stock has underperformed the broader market, reflecting investor concerns about its ability to reverse the declining consumer interest in its core products. Moving on to our second brand, Campbell Soup Company, another American food icon that is watching its consumer base erode. Founded in 1869, Campbell's has been synonymous with canned soup for generations. However, the company reported a 3% decline in soup sales in 2023, continuing a troubling multi-year trend. The primary issue? Canned soup simply doesn't align with modern eating habits. Today's consumers are increasingly looking for fresh, minimally processed options with clean ingredient lists. Campbell's soups, with their high sodium content and long shelf life, represent the opposite of what many health-conscious shoppers are seeking. The pandemic briefly boosted Campbell's sales as consumers stocked their pantries, but that temporary surge has completely reversed. Campbell's has attempted to modernize its offerings with organic soups and broths, as well as acquiring brands like Bolthouse Farms to diversify into fresher categories. However, these efforts haven't been enough to offset the decline in their core soup business. The company is also facing increased competition from premium soup brands and fresh prepared options available in grocery store deli sections. For younger consumers especially, Campbell's struggles with an image problem. Many view the brand as outdated and associate it with their grandparents' generation rather than modern cuisine. Third on our list is General Mills, the company behind iconic brands like Cheerios, Betty Crocker, and Pillsbury. While still a massive player in the food industry, General Mills has been experiencing concerning consumer defections, particularly in its cereal division. Cold cereal consumption in America has been declining for years, with sales volumes dropping approximately 1.5% annually since 2015. The breakfast landscape has fundamentally changed. Consumers are increasingly skipping traditional sit-down breakfasts in favor of on-the-go options, protein-focused meals, or simply coffee. Even within the cereal category, General Mills faces intense competition from both premium health-focused brands and cheaper store alternatives. The company's attempts to revitalize interest through nostalgic marketing and limited edition flavors have generated temporary spikes but failed to reverse the overall downward trend. Their acquisition of natural pet food company Blue Buffalo for $8 billion in 2018 was a clear acknowledgement that they needed to diversify beyond their traditional food categories. However, this diversification strategy hasn't stopped the bleeding in their core business. General Mills has also struggled with price sensitivity. As they've raised prices to combat inflation, many consumers have traded down to store brands or simply reduced their cereal consumption altogether. The company's most recent quarterly report showed a 4% decline in volume, indicating that fewer units are being sold despite revenue being propped up by higher prices. Fourth on our list is Kellogg's, now known as Kellanova, after spinning off its North American cereal business. Like General Mills, Kellogg's has been hit hard by changing breakfast habits and health concerns. Their iconic brands like Frosted Flakes, Rice Krispies, and Pop-Tarts have seen declining sales volumes for several consecutive years. The company's challenges extend beyond just breakfast cereals. Their snack brands, including Pringles and Cheez-It, face increasing competition from newer, trendier options with cleaner ingredient lists. Kellogg's has attempted to adapt by acquiring smaller, health-focused brands and introducing organic versions of their classics. But these efforts haven't stemmed the tide of consumers leaving for alternatives. Particularly concerning for Kellogg's is their declining relevance with younger consumers. Gen Z and millennials are less likely to have brand loyalty to traditional packaged food companies and are more willing to try new, innovative products from startup brands. Kellogg's decision to split into 3 separate companies in 2022 was a direct response to these challenges, allowing each business unit to focus more specifically on its unique market challenges. The 5th brand on our list is Coca-Cola, which might surprise some given its status as one of the world's most recognized brands. However, Coca-Cola has been experiencing a steady decline in its core soda business for years. In North America, soda consumption has been declining since the early 2000s, with per capita consumption dropping by over 25% in the past 2 decades. Health concerns about sugar consumption and artificial ingredients have driven many consumers away from traditional sodas, while Coca-Cola has diversified into water, tea, coffee, and energy drinks through acquisitions like Vitamin Water, Costa Coffee, and a stake in Monster Energy. These haven't fully offset the decline in their flagship products. The company has attempted to revitalize its soda business with innovations like Coca-Cola Zero Sugar and smaller portion sizes, but the fundamental challenge remains. Younger consumers simply don't drink as much soda as previous generations did. Coca-Cola's most recent earnings report showed a 1% decline in North American volume, masked by price increases that boosted revenue. Additionally, Coca-Cola faces increasing competition from a proliferation of beverage options that didn't exist a generation ago, from kombucha and sparkling water to functional beverages with added health benefits. The days when consumer beverage choices were limited to soda, juice, or water are long gone, and this expanded competitive landscape continues to erode Coca-Cola's market share. 6th on our list is ConAgra Brands, the company behind familiar names like Slim Jim, Chef Boyardee, Reddi-wip, and Healthy Choice. ConAgra has been struggling with declining sales volumes across several of its key brands. In their most recent fiscal year, the company reported a 3.4% decline in volume despite raising prices by 5.7%. ConAgra's portfolio is heavily weighted toward processed and packaged foods, categories that have fallen out of favor with health-conscious consumers. Their frozen meal brands like Banquet and Marie Callender's face particular challenges as consumers increasingly seek fresher options or higher quality frozen alternatives with cleaner ingredient lists. The company has attempted to modernize its offerings through acquisitions like Angie's Boom Chicka Pop and the launch of plant-based products under the Gardein brand. However, these efforts haven't been sufficient to offset declines in their legacy brands. ConAgra also faces the challenge of competing with both premium specialty brands and cheaper store alternatives, leaving their middle market offerings squeezed from both directions. Supply chain disruptions and inflation have further complicated ConAgra's situation. The company has implemented significant price increases, which have accelerated consumer defection to alternatives. Their most recent earnings call acknowledged that they've lost market share in several key categories as consumers trade down to more affordable options. Seventh on our list is Mondelez International, the company behind iconic snack brands like Oreo, Ritz, and Cadbury. While Mondelez remains profitable, they're facing concerning trends in their North American business. The company reported a 3.1% decline in North American volumes in their most recent quarter, indicating that fewer consumers are purchasing their products. Mondelez's challenges stem from several factors. Health-conscious consumers are increasingly avoiding traditional packaged snacks in favor of options with cleaner ingredient lists and better nutritional profiles. The company's core products, like cookies and crackers, are precisely the types of ultra-processed foods that health authorities have been warning against. Additionally, Mondelez has implemented substantial price increases across its portfolio, with some products seeing price hikes of over 15% in the past 2 years. These increases have pushed budget-conscious consumers towards store brands and more affordable alternatives. The company's attempts to introduce thins versions of their cookies and better-for-you options haven't fully addressed consumer concerns about ingredients and processing. Mondelez has been more successful internationally than domestically, with stronger growth in emerging markets. However, their North American business, which remains their largest and most profitable segment, continues to face headwinds as consumer preferences evolve away from their core offerings. Eighth on our list is Hershey's, America's iconic chocolate company. Hershey's reported a 6.5% decline in North American volumes in their most recent quarter, a concerning trend for a company that has dominated American chocolate for generations. Several factors are contributing to Hershey's challenges. First, consumer preferences in chocolate are evolving. Premium and artisanal chocolate brands have gained significant market share, particularly among younger consumers who are willing to pay more for higher quality ingredients and unique flavor profiles. Hershey's traditional milk chocolate offerings are increasingly viewed as overly sweet and basic compared to these alternatives. Second, health concerns about sugar consumption have impacted the entire candy category. While chocolate has benefited from some research suggesting moderate consumption of dark chocolate may have health benefits, Hershey's portfolio is heavily weighted toward milk chocolate and candy products with higher sugar content. Third, Hershey's has implemented substantial price increases, with some products seeing price hikes of over 20% in the past 2 years. These increases have been particularly noticeable to consumers given the relatively small unit size of candy products, leading to sticker shock and trading down to alternatives. Hershey's has attempted to address these challenges through acquisitions of premium brands like Dagobah and Scharfenberger, as well as introducing organic and higher cocoa content options. However, these efforts remain a small portion of their overall business, which continues to be dominated by traditional brands like Hershey's Kisses, Reese's, and Kit Kat that are losing consumer interest. Ninth on our list is PepsiCo, which faces many of the same challenges as Coca-Cola in its beverage business, but has the added complexity of a large snack food portfolio through its Frito-Lay division. PepsiCo reported a 2% decline in North American beverage volumes in their most recent quarter, continuing a multi-year trend of declining soda consumption. While PepsiCo's snack business has been more resilient than its beverage division, even Frito-Lay is beginning to show signs of weakness. The company reported flat volumes in North American snacks despite price increases, indicating potential market saturation and consumer resistance to higher prices. PepsiCo has been more aggressive than some competitors in diversifying its portfolio, acquiring healthier brands like Naked Juice, Sabra Hummus, and SodaStream. However, these healthier alternatives remain a relatively small portion of their overall business compared to core brands like Pepsi, Mountain Dew, Doritos, and Lay's, all categories facing headwinds from changing consumer preferences. The company has also invested heavily in marketing and product innovation, including the launch of Pepsi Zero Sugar and new flavors across their snack portfolio. Despite these efforts, PepsiCo continues to lose market share to smaller, more nimble competitors that better align with contemporary consumer preferences for less processed options with cleaner ingredient lists. Rounding out our list at number 10 is Kellogg's spin-off, WK Kellogg Co., which now houses the North American cereal business, including iconic brands like Frosted Flakes, Rice Krispies, and Special K. Since becoming an independent company in 2023, WK Kellogg has faced significant challenges, with volumes declining by 5.2% in their first quarter as a standalone business. The fundamental issue for WK Kellogg is that cereal consumption continues to decline in North America. Changing breakfast habits, concerns about sugar and processing, and a proliferation of alternative breakfast options have all contributed to this trend. The company's core products, sweetened, processed cereals, are precisely the type of foods that health-conscious consumers are increasingly avoiding. WK Kellogg has attempted to revitalize interest through nostalgic marketing, limited edition flavors, and partnerships with other brands. However, these efforts have generated only temporary spikes in interest rather than reversing the overall downward trend. The company has also introduced more protein-focused and lower sugar options, but these haven't gained sufficient traction to offset declines in their traditional cereals. As a smaller, more focused company, WK Kellogg may have the agility to respond more effectively to changing consumer preferences than it could as part of the larger Kellogg's organization. However, the fundamental challenge remains: convincing modern consumers that cereal deserves a place in their breakfast routine when so many alternatives exist. So what do these declining brands have in common? Several key factors emerge. First, most of these companies are heavily invested in processed and packaged foods at a time when consumers are increasingly seeking fresher, less processed options. Second, many have been slow to adapt to changing consumer preferences, particularly around health and ingredient transparency. Third, substantial price increases have accelerated consumer defection to alternatives, particularly store brands. The challenges facing these companies reflect broader shifts in American food culture. Younger consumers are less brand loyal, more health conscious, and more willing to try new, innovative products from startup brands. The internet and social media have democratized information about food, making it easier for consumers to research ingredients and processing methods, often to the detriment of legacy brands. However, it's worth noting that these companies still generate billions in revenue and maintain significant market presence. Their decline is relative rather than absolute. They're losing market share and consumer interest gradually rather than collapsing overnight. This gives them time to adapt and evolve, though whether they'll successfully do so remains to be seen. Some are taking more aggressive steps than others. Kraft Heinz has been divesting brands that don't align with current consumer preferences while investing in plant-based alternatives. PepsiCo continues to acquire smaller, healthier brands to diversify its portfolio. Campbell's has expanded into fresh and refrigerated foods through strategic acquisitions. The question for these companies is whether these efforts will be sufficient to reverse the tide of consumer defection or merely slow it down. The food industry is notoriously difficult to pivot quickly. Manufacturing facilities, supply chains, and brand identities built over decades can't be transformed overnight. For consumers, the decline of these legacy brands represents both challenges and opportunities. On one hand, beloved products that have been part of American food culture for generations may eventually disappear or become unrecognizable as companies reformulate to meet changing preferences. On the other hand, the proliferation of alternatives from both large competitors and innovative startups gives consumers more choices than ever before. As we look to the future, it's clear that the American food landscape will continue to evolve. The brands that survive and thrive will be those that can authentically align with contemporary values around health, sustainability, and transparency while still delivering on taste and convenience. For the 10 brands we've discussed today, the path forward will require bold innovation, strategic acquisitions, and perhaps most importantly, a willingness to let go of outdated notions of what American consumers want from their food.